The glowing tickers across Times Square and the digital screens of every smartphone in America are broadcasting a singular and intoxicating message on this Tuesday, the 21st of April, 2026. The S&P 500 has just surged past the 6,900 mark, teetering on the edge of a historic 7,000-point milestone that seemed like a fever dream only a few years ago. MarketWatch and Bloomberg are flooded with headlines about the cooling oil prices and the geopolitical breakthroughs between the United States and Iran, fueling a sense of invincibility that permeates every coffee shop and boardroom from New York to San Francisco. You look at your brokerage account and see the vibrant green numbers climbing higher, feeling a rush of dopamine that falsely tells you that you have finally cracked the code to infinite wealth and that the gravity of economic cycles no longer applies to your portfolio. However, beneath this veneer of unprecedented prosperity lies a sophisticated psychological illusion that has historically served as a harbinger of financial ruin for the unsuspecting masses. This phenomenon, often referred to as the wealth effect by economists at the Federal Reserve, convinces the average worker that they are significantly richer than they actually are, leading to a dangerous expansion of lifestyle and a reckless abandonment of fundamental financial discipline. While the broad market indices represent the collective valuation of the largest corporations in the United States, they do not reflect the liquid reality of your personal savings or your ability to weather a sudden economic storm. The collective euphoria currently sweeping through Wall Street is acting as a powerful anesthetic, numbing the rational mind to the reality that market peaks are often built on the fragile foundations of sentiment rather than sustainable economic growth for the individual household. The most dangerous assumption you can make in this high-stakes environment is believing that the current upward trajectory is a permanent feature of the new economy rather than a temporary phase of the market cycle. Many investors are currently falling into the trap of survivor bias, looking only at the recent gains while ignoring the historical data from organizations like Vanguard and Fidelity, which suggest that periods of extreme valuation are almost inevitably followed by significant mean reversion. As the S&P 500 approaches that psychological 7,000-point barrier, the noise from financial influencers and mainstream media becomes a siren song, luring you to take on more risk at the exact moment you should be exercising the most caution. This is the moment where the distinction between a calculated investor and a reckless gambler becomes blurred, and the consequences of being on the wrong side of that line have never been more severe for your long-term financial freedom. We must ask ourselves who truly benefits from this widespread obsession with hitting record highs, while the average American household continues to struggle with the lingering effects of inflation and the mounting costs of debt. The financial industry thrives on the high volume of transactions generated by your excitement and your fear, often encouraging you to stay fully invested or even increase your exposure through dangerous leverage at the absolute peak. This analysis aims to peel back the layers of this sugar-coated mousetrap and reveal the cold, hard mechanics of how real wealth is preserved when everyone else is busy chasing the mirage of a never-ending bull market. If you are currently feeling the urge to double down on your positions or buy into the latest hyped-up sector, you are exactly the person who needs to understand the hidden forces at play before the music stops and the lights come on. The biological engine driving your financial decisions at this very moment is not your rational mind, but a primitive reward system designed for survival in a world of scarcity that no longer exists. When you witness the S&P 500 shattering records and surging toward the 7,000-point mark, your brain releases a massive flood of dopamine into the nucleus accumbens, creating a state of hyper-optimism and significantly diminished risk perception. This chemical surge acts like a powerful drug, making every speculative investment look like a guaranteed win and every cautious voice seem like a relic of a bygone era. Behavioral psychologists have long noted that this neurological feedback loop is what sustains massive market bubbles, as the intense fear of missing out, or FOMO, completely overrides the fundamental instinct for capital preservation and long-term strategic planning. The Federal Reserve has extensively documented a phenomenon known as the wealth effect, which describes the direct correlation between rising asset prices and increased consumer spending across the American economy. According to historical data from various Federal Reserve economic studies and household net worth reports, for every dollar of increased paper wealth in the stock market, households tend to increase their annual spending by a measurable and significant margin. While this may seem like a logical byproduct of success on a small scale, when applied to trillions of dollars in market capitalization, it creates a massive wave of artificial demand that fuels inflation and encourages individuals to take on high-interest consumer debt. You are essentially spending tomorrow's uncertain gains to fund today's certain and permanent liabilities, creating a dangerous mismatch in your personal balance sheet that can lead to catastrophic failure during a correction. Beyond the biology of the brain, there is a sophisticated and invisible architecture of consumption designed to extract wealth from you at the very moment you feel most prosperous and invincible. Financial institutions and retail corporations leverage big data and advanced psychological profiling to target investors who are experiencing this peak market euphoria, offering luxury goods and premium lifestyle services that feel affordable only because of your unrealized gains. This is the sugar-coated mousetrap of the modern era, where your perceived success in the financial markets is used as a psychological lever to pull you into a cycle of lifestyle inflation. Many Americans find themselves in a paradoxical situation where their brokerage account balance is at an all-time high, yet their actual liquid bank balance is dwindling due to the irresistible lure of high-end consumption and upgraded living standards. The systemic flaw in this logic is the dangerous and often fatal confusion between unrealized paper wealth and the actual liquid purchasing power required to survive a sudden and inevitable economic downturn. The stock market serves as a brilliant and efficient money printing machine as long as the numbers remain green and the general sentiment remains bullish, but it quickly becomes a ruthless vacuum of capital the moment liquidity evaporates and market panic sets in. History shows that the very people who feel the most confident at 6,900 points are often the ones who have the least amount of cash reserves to survive a standard 20% correction in the broad market indices. Understanding that your wealth is merely a set of digital entries until it is strategically realized and protected is the first essential step in breaking free from the psychological chains of the market current manic phase. We must recognize that the modern financial ecosystem is not a neutral playground, but a highly engineered environment that rewards collective madness while punishing individual discipline and patient capital. Every notification from your trading app and every breaking news alert from Wall Street is a carefully crafted stimulus designed to keep you engaged, emotional, and prone to making high-frequency decisions that benefit brokers more than your future self. By identifying these root causes, we can begin to peel back the layers of deception and look at the cold, hard mechanics of how money actually moves and grows over time. But if the psychology of the market is designed to mislead us, how can we use the absolute logic of mathematics to build a fortress that no market crash can ever breach? The fundamental mathematics of wealth creation is often obscured by the complex jargon of Wall Street, yet the core principles remain as unyielding as the laws of physics. To understand why the current surge towards 7,000 points is so precarious, we must first examine the brutal asymmetry of investment losses, which dictates that a percentage decline requires a significantly larger percentage gain just to return to the original starting point. For example, a standard 10% market correction at these elevated levels requires an 11% gain to break even, but a more severe 30% crash necessitates a staggering 43% recovery. When you are investing at historical peaks like the one we are witnessing in April 2026, the mathematical margin for error shrinks drastically, while the potential for a compounding downward spiral grows exponentially for those who lack a structured exit strategy or a diversified portfolio. The most dangerous catalyst in the modern financial ecosystem is the excessive use of margin and leveraged instruments, which many retail investors are currently using to chase the final few percentage points of this bull market. According to recent data trends monitored by major institutions such as Fidelity and the Financial Industry Regulatory Authority, margin debt often reaches its peak levels exactly when market sentiment is at its most euphoric and valuations are most stretched. If you are trading on a 2-to-1 margin, a seemingly minor 10% dip in the S&P 500 instantly translates into a 20% loss of your actual equity, often triggering a catastrophic margin call. This forced liquidation of assets occurs at the worst possible time when prices are falling, effectively stripping you of your capital and preventing you from participating in the eventual recovery that follows every market cycle. In stark contrast to the high-stakes gamble of market timing and leverage, the mechanical power of dollar-cost averaging provides a mathematical fortress that thrives on the very volatility that destroys the undisciplined speculator. By consistently investing a fixed amount of capital at regular intervals regardless of the current price, you are mathematically guaranteed to purchase more shares when prices are low and fewer shares when prices are high. Historical performance data from Vanguard emphasizes that this systematic approach significantly lowers the average cost per share over long durations, effectively neutralizing the psychological urge to buy at the absolute peak or sell at the terrifying bottom. This strategy transforms market volatility from a source of anxiety into a powerful engine for wealth accumulation, allowing the principle of compound interest to work its magic on a larger base of shares acquired during periods of market weakness. The true secret to long-term financial survival lies in the mastery of the Rule of 72 and the understanding of how small, consistent percentages can lead to massive divergent outcomes over a decade or more. While the crowd is currently obsessed with the daily fluctuations of the index at 6,900 points, the successful investor focuses on the internal rate of return and the impact of hidden costs such as management fees and taxes, which can erode up to 1/3 of a portfolio's total value over time. By optimizing these mechanical variables and maintaining a high savings rate, you create a self-sustaining financial machine that is independent of the manic-depressive nature of the public markets. The goal is not to predict the exact moment the S&P 500 will hit 7,000 points, but to ensure that your financial structure is robust enough to profit, regardless of whether the index goes up to 8,000 or retreats back to 5,000 inches the coming month. As we look at the raw data and the cold logic of these financial equations, it becomes clear that the path to true wealth is paved with discipline rather than luck or insider timing. The math proves that the greatest risk is not the market dropping, but rather your own emotional reaction to that drop, and the structural weaknesses of a portfolio built on the shifting sands of debt and hype. If the mechanics of money are so predictable and logical, why is it that so many intelligent people still find themselves trapped in a cycle of financial anxiety and poor decision-making when the stakes are highest? This leads us to the most critical transformation of all, which is the fundamental shift in how you perceive the very concept of value and the price of your future freedom. To truly master your financial destiny in this era of the S&P 500 climbing towards 7,000 points, you must undergo a fundamental transformation in how you define the very concept of wealth itself. Most people view wealth as a competitive scorecard or a mountain of digital currency that grants them access to luxury goods and social status among their peers in an increasingly shallow society. However, the elite 1% of wealth builders understand that true wealth is measured in the currency of time and the degree of autonomy you possess over your daily schedule and personal life. This shift from a consumerist perspective to a freedom-based perspective is what separates those who are temporarily rich from those who are permanently wealthy and secure regardless of market fluctuations. When you see the stock market reaching for historic highs, the strategic mind does not just see a profit opportunity, but a potential moment of extreme fragility for those who have tied their entire identity to a volatile index. This transformation requires you to abandon the scarcity mindset, which dictates that you must capture every single percentage of growth or risk being left behind forever in the race for global prosperity. A scarcity mindset is a psychological prison that forces you into making reactive and emotional decisions based on the current headlines rather than your long-term objectives and deeply held personal values. In contrast, a strategic mindset operates on the principle of abundance and cyclicality, recognizing that the financial markets are a series of recurring waves, and that missing one wave does not mean you will never catch another one. By accepting that you do not need to be right every single day or participate in every speculative frenzy, you gain the psychological clarity needed to make calm and rational decisions when everyone else is descending into a state of panic. One of the most difficult parts of this mindset shift is the willingness to make decisions that might appear poor or overly cautious to the outside world in the short term. Keeping a significant portion of your portfolio in cash or low-risk liquid assets while the stock market is booming can feel like a failure when your neighbors are boasting about their massive gains from high-risk investments or crypto assets. However, this liquidity is not idle money, but a powerful form of optionality that gives you the right but not the obligation to take advantage of future distress in the markets when prices are more attractive. The strategic investor understands that being able to sleep soundly during a market crash is worth far more than a few extra percentage points of growth that could be wiped out in a single week of high-intensity selling. We must also redefine our understanding of opportunity cost, which is frequently used by the financial industry to shame individuals into staying fully invested even when valuations are clearly unsustainable by historical standards. The traditional definition focuses solely on the potential gains you miss by not being in the market, but the more critical definition involves the cost of being trapped in a declining asset when superior opportunities emerge at much lower prices. If you are fully committed at the absolute peak, you have zero ability to pivot or capitalize on the inevitable corrections that characterize the history of the American economy and the global financial system. True strategic advantage comes from having the patience to wait for the fat pitches and the discipline to ignore the noise of a crowd that is increasingly detached from reality. Ultimately, the goal of this psychological pivot is to transition from a participant who is controlled by the market into a commander who uses the market as a tool for personal liberation and generational wealth. You are no longer working for your money or watching the ticker with a sense of desperation, but rather you are managing a portfolio of assets designed to provide you with the ultimate luxury of saying no to things that do not align with your vision. This sense of peace and control is the ultimate indicator of financial success, far outweighing any specific number on a brokerage statement or the total value of your investment accounts at any given moment. By changing your perspective on what it means to be wealthy, you effectively immunize yourself against the viral spread of market euphoria and prepare your mind for the practical steps needed to secure your future. In the current environment of April 2026, with the S&P 500 hitting record highs, your first and most critical action is to execute a systematic rebalancing of your investment portfolio to restore your original risk tolerance. You must calculate your current asset allocation and compare it to your long-term target, as the recent stock market surge has likely pushed your equity exposure to dangerous levels that exceed your actual ability to withstand a sudden crash. Selling a portion of your winning stocks to purchase undervalued assets or increase your cash reserves is not a sign of weakness, but a hallmark of a professional investor who understands the necessity of locking in gains. This mechanical process removes the emotional burden of trying to time the absolute market peak and ensures that you are consistently selling high and maintaining a defensive posture while the rest of the world is recklessly overextending themselves. The second step is to construct a liquidity fortress by auditing your emergency fund and adjusting it for the specific inflationary pressures and cost of living realities of the year 2026. You should aim to hold at least 6 to 12 months of essential living expenses in a highly liquid and low-risk account that is completely separate from your brokerage or trading platforms. This capital serves as your ultimate insurance policy against the volatility of the labor market and the potential for a credit crunch that often follows periods of extreme asset price inflation. Having this cash available allows you to remain calm and rational when the market eventually enters a correction phase, as you will not be forced to sell your investments at depressed prices just to cover your monthly mortgage or grocery bills. Finally, you must implement a rigorous friction filter by establishing a mandatory 72-hour waiting period for any new investment decisions or significant lifestyle purchases that are triggered by market news. This psychological barrier is designed to allow your dopamine levels to normalize and your prefrontal cortex to regain control after being stimulated by the sensational headlines of the S&P 500 approaching the 7,000-point milestone. During this cooling off period, you should objectively evaluate whether the proposed transaction aligns with your long-term financial plan or if it is merely a reactive attempt to chase the latest trend. By introducing intentional friction into your financial decision-making process, you effectively shield yourself from the impulsive behaviors that destroy more wealth than any market crash ever could. These actions may seem simple, yet they require an extraordinary amount of discipline to maintain when the collective sentiment is pushing you toward the opposite direction of greed and excess. By focusing on these controllable variables, you move from being a passive observer of market movements to an active architect of your own financial security. But even with a solid plan and a fortified portfolio, there is one final trap that often catches even the most experienced investors just as they reach the finish line of their financial goals. As we conclude this analysis, we must identify the ultimate risk that could undo all of your hard work and throw you back into the cycle of financial dependency. The most insidious threat to your enduring prosperity is not a sudden collapse of the global stock market, but the slow and silent poison of lifestyle inflation. As you watch the S&P 500 dance around the 7,000-point mark in this spring of 2026, it is incredibly easy to justify a more expensive car, a larger mortgage, or a series of luxury vacations that you believe you have finally earned through your investment success. This is the ultimate sugar-coated mousetrap because it effectively resets your financial baseline, ensuring that you remain a slave to your paycheck and your portfolio, regardless of how many millions of dollars you might accumulate on paper. If your cost of living rises in perfect lockstep with your investment gains, you are not actually building wealth, but rather building a more gilded and expensive cage for your future self that will eventually require even greater risks just to maintain. Think back to the vivid image of those glowing green tickers in Times Square that we discussed at the very beginning of this journey into the heart of the modern bull market. Those numbers are merely digital representations of collective sentiment and corporate valuations that can vanish just as quickly as they appeared in the heat of a sudden market panic or a geopolitical shift. When the history books are written about this era of the late 2020s, they will not focus on the day the index hit 7,000, but rather on the individuals who had the foresight to recognize the mirage for what it was. True financial victory is achieved not by riding the wave to its highest peak, but by having the courage to step off that wave and onto solid ground before it crashes against the jagged rocks of economic reality. You must remember that the market does not owe you a profit, and the wealth effect is only a benefit if you have the discipline to convert paper gains into tangible security. Your final defense against the gravity of financial ruin is to maintain a radical and unwavering gap between your actual level of wealth and the lifestyle that you project to the rest of the world. By keeping your expenses stable while your assets continue to compound, you create a massive margin of safety that protects you from the inevitable downturns and the unforeseen crises that are a natural part of any functioning economy. The goal is to reach a point where the fluctuations of the S&P 500 are merely interesting data points rather than sources of existential dread or temporary euphoria that dictate your emotional well-being. Realize that your freedom is a finite resource that is purchased with the capital you choose not to spend today, and that the greatest investment you will ever make is the one that secures your peace of mind for the rest of your life. As the screens fade and the noise of the market analysts grows quiet, the only thing that remains is your own level of discipline and your commitment to the long-term vision you have established for yourself. The S&P 500 may reach 7,000, 8,000, or even 10,000 in the years to come, but your true net worth will always be defined by your character and your ability to remain rational when the rest of the world is losing its mind to greed. Stay focused on the mechanics, respect the mathematics of risk, and never let a temporary peak in the market convince you to compromise your permanent future. The journey to wealth is a marathon of endurance rather than a sprint toward a fleeting number on a digital screen, and those who understand this truth are the only ones who will truly finish the race with their freedom intact.